Welcome. Today we're diving into the world of investment funds, focusing on a comparative analysis between private funds and public funds. Understanding the differences between these two types is crucial for investors, financial professionals, and anyone interested in how capital is managed and grown. In this video, we'll break down their structures, advantages, risks, and more. Let's start by defining what private and public funds are, and why this comparison matters in the financial landscape. Private funds are investment vehicles that pool money from a limited number of investors. These investors are typically high net worth individuals or institutional clients. Private funds are not offered to the general public and are usually exempt from many regulatory requirements that public funds must follow. They often include hedge funds, private equity funds, and venture capital funds. Because of their exclusivity, private funds can pursue more flexible and sometimes riskier investment strategies. Public funds, on the other hand, are investment products available to the general public. These include mutual funds and exchange-traded funds, ETFs. Public funds are highly regulated, ensuring transparency and investor protection. Anyone can invest in public funds, often with lower minimum investments compared to private funds. Their portfolios are typically more diversified and subject to strict disclosure requirements, making them accessible and understandable for everyday investors. Structure of private and public funds differ significantly. Private funds are often structured as limited partnerships or limited liability companies, giving fund managers more control over investment decisions. Public funds, however, are typically organized as open-ended investment companies or trusts, with strict rules on portfolio composition and liquidity. These structural differences impact everything from management style to investor rights and reporting obligation. Eligibility to invest in private funds is generally restricted. Investors usually need to meet certain income or net worth thresholds, often defined as accredited investors. This limits access to a select group. In contrast, public funds are open to anyone, regardless of financial status, making them much more inclusive. This difference shapes the investor base and influences the types of strategies each fund can pursue. Regulation is a major point of distinction. Public funds are subject to rigorous oversight by regulatory bodies, such as the SEC in the United States. They must adhere to strict disclosure, reporting, and operational standards. Private funds, however, operate with fewer regulatory constraints, allowing for more investment flexibility but also higher risk. This regulatory gap is a key factor in understanding the risk-return profiles of each fund type. Transparency is another area where public and private funds diverge. Public funds must regularly disclose their holdings, performance, and fees to investors and regulators. This transparency builds trust and allows investors to make informed decisions. Private funds, on the other hand, are not required to provide the same level of disclosure, which can make it harder for investors to fully understand the risks and strategies involved. Minimum investment amounts are typically much higher for private funds than for public funds. Private funds often require hundreds of thousands or even millions of dollars to participate, reflecting their exclusive nature. Public funds, by contrast, are designed for accessibility, with minimum investments as low as a few dollars. This difference makes public funds a practical choice for most individual investors. Liquidity refers to how easily investors can access their money. Public funds are highly liquid, allowing investors to buy or sell shares on any business day. Private funds, however, often have lock-up periods restricting withdrawals for months or even years. This illiquidity can be a drawback for investors who may need quick access to their capital. These structures also differ between private and public funds. Private funds often charge both a management fee and a performance fee, such as the well-known 2 and 20 model. Public funds typically charge only a management fee, which is usually lower. Understanding these fees is essential as they directly impact investor returns over time. Private funds have the flexibility to pursue a wide range of investment strategies, including leverage, derivatives, and alternative assets. This can lead to higher returns but also greater risk. Public funds, due to regulatory constraints, generally stick to more traditional and diversified investment approaches. This difference shapes the risk and return profiles of each fund type. Risk is inherent in all investments, but private funds often carry higher risk due to their use of leverage and complex strategies. Public funds, with their regulatory oversight and diversification, tend to be less risky. However, lower risk usually means lower potential returns. It's important for investors to match their risk tolerance with the appropriate fund type. Private funds can offer higher return potential, especially for those willing to accept greater risk and illiquidity. Their managers have more freedom to pursue aggressive strategies. Public funds, while generally offering more modest returns, provide stability and steady growth for long-term investors. This trade-off is a central consideration when choosing between private and public funds. Diversification is a key principle in investing. Public funds are often highly diversified, spreading risk across many assets and sectors. Private funds may be more concentrated, focusing on specific industries or strategies. While concentration can boost returns, it also increases risk. Diversification in public funds helps protect investors from market volatility. Expertise of fund managers plays a significant role in performance. Private fund managers often have specialized knowledge and experience, allowing them to exploit market inefficiencies. Public fund managers, while also skilled, must operate within tighter regulatory boundaries. The difference in managerial freedom can influence returns and risk. Public funds are required to provide regular reports to investors, including performance updates, portfolio holdings, and fee disclosures. This level of communication ensures transparency and keeps investors informed. Private funds may offer less frequent or detailed reporting, which can make it harder for investors to track their investments. Tax treatment can vary significantly between private and public funds. Public funds often provide tax advantages, such as favorable capital gains treatment or tax-exempt income for certain funds. Private funds may involve more complex tax reporting and potential liabilities. Investors should consult with tax professionals to understand the implications of each fund type. Private funds often invest in alternative assets such as real estate, private companies, or commodities. These assets can offer diversification and higher returns but also come with unique risks. Public funds generally focus on stocks, bonds, and other traditional securities, providing more predictable performance. Investing in private funds requires thorough due diligence, as information is less readily available. Investors must carefully evaluate fund managers, strategies, and risks. Public funds, with their transparency and regulatory oversight, make the due diligence process simpler and less time-consuming for the average investor. Public funds are often measured against widely recognized benchmarks such as the S&P 500. This allows investors to easily compare performance. Private funds may use custom benchmarks or none at all, making it harder to assess relative success. Understanding benchmarks is key to evaluating fund performance. Private funds often impose redemption restrictions such as lockup periods or notice requirements before withdrawals. Public funds, in contrast, allow investors to redeem shares at net asset value on any business day. These restrictions can affect an investor's ability to access their money when needed. Public funds offer strong investor protections, including regulatory oversight, insurance, and clear dispute resolution mechanisms. Private funds, with less oversight, place more responsibility on investors to protect their interests. This difference is crucial for those who prioritize safety and legal recourse. Public funds are required to report performance and holdings at least quarterly and often more frequently. Private funds may report only annually or semi-annually. This difference affects how quickly investors can react to changes in fund performance or strategy. Public funds typically distribute returns such as dividends or interest to investors on a regular basis. Private funds may reinvest profits or distribute them less frequently, depending on the fund's strategy. This impacts how and when investors receive income from their investments. Public funds often manage large pools of assets, sometimes reaching billions of dollars. Private funds, while they can be sizable, are generally smaller due to their limited investor base. Fund size can influence investment opportunities, fees, and overall strategy. Public funds are widely marketed through banks, brokers, and online platforms, making them easily accessible. Private funds rely on direct relationships and word of mouth with limited advertising due to regulatory restrictions. This affects how investors discover and access each fund type. Joining a public fund is usually straightforward, often requiring just a few clicks online. Private funds, however, involve a more complex onboarding process, including investor qualification, legal documentation, and sometimes interviews. This complexity reflects the higher stakes and regulatory requirements for private investments. Private funds often use leverage to amplify returns, borrowing money to increase their investment exposure. While this can boost profits, it also increases risk. Public funds are generally more conservative with leverage due to regulatory limits and the need to protect retail investors. Valuing assets in private funds can be complex, especially for illiquid or alternative investments. Public funds, with their focus on listed securities, use transparent market prices for valuation. This difference affects how fund performance is measured and reported. Private funds are commonly structured as limited partnerships or LLCs, offering flexibility in management and taxation. Public funds are usually organized as investment companies or trusts, subject to specific legal frameworks. These structures influence everything from governance to investor rights. Private funds may impose redemption fees or penalties for early withdrawals, discouraging investors from pulling out capital prematurely. Public funds, with their daily liquidity, rarely charge such fees. Understanding these costs is important for managing investment timelines. Public funds often have dedicated investor relations teams to answer questions and provide support. Private funds may offer more personalized service but with fewer resources. The level of investor support can influence satisfaction and trust. Public funds are generally open-ended, operating indefinitely as long as there is investor demand. Private funds often have a fixed lifespan, such as 7–10 years, after which assets are liquidated and proceeds returned to investors. This impacts long-term planning and investment horizons. Governance structures differ between private and public funds. Public funds have boards of directors or trustees overseeing management, ensuring accountability. Private funds may have less formal governance with more power concentrated in the hands of fund managers. Public funds are distributed through a wide range of channels, including banks, brokers, and online platforms. Private funds rely on direct marketing and private placements, limiting their reach. This affects how easily investors can access each type of fund. Investing in public funds requires minimal paperwork, often just a prospectus and account forms. Private funds involve extensive legal documentation, including private placement memorandums, subscription agreements, and more. This paperwork reflects the complexity and risks of private investments. Public funds often aim for steady growth, income, or capital preservation, catering to a broad investor base. Private funds may pursue aggressive growth, niche strategies, or alternative investments targeting sophisticated investors. Understanding fund objectives helps align investments with personal goals. Public funds must provide detailed risk disclosures in their prospectuses, helping investors understand potential downsides. Private funds may offer less comprehensive disclosures, placing more responsibility on investors to assess risks independently. Public funds report performance using standardized methods, making it easy to compare across funds. Private funds may use different metrics or reporting periods, complicating performance evaluation. Consistent reporting helps investors make informed choices. When a public fund closes, assets are typically liquidated and returned to investors at market value. Private funds with their illiquid assets may take longer to wind down, and final payouts can be uncertain. This difference affects how quickly investors can recover their capital in the event of fund closure. Public funds often provide educational resources, seminars, and online tools to help investors make informed decisions. Private funds may offer less in the way of investor education, expecting participants to have a higher level of financial knowledge. Accessibility is a defining feature of public funds. They are designed for mass participation with low minimums and easy entry. Private funds, by contrast, are exclusive, requiring significant capital and meeting strict eligibility criteria. This shapes who can participate and benefit from each type of fund. Public funds are available to investors worldwide, often listed on major exchanges and accessible through international brokers. Private funds may have geographic restrictions, limiting participation to certain regions or countries. This affects the global diversification opportunities for investors. Sum up: private and public funds differ in many important ways: structure, regulation, transparency, fees, risk, and accessibility. Private funds offer higher potential returns and flexibility but come with greater risk and exclusivity. Public funds provide safety, transparency, and ease of access, making them ideal for most investors. Understanding these differences is essential for making informed investment decisions. Choosing between private and public funds depends on your financial goals, risk tolerance, and investment knowledge. Both have unique advantages and challenges. By understanding the comparative analysis we've discussed, you can better align your investment choices with your personal objectives. Thank you for joining us on this deep dive into private versus public funds. Stay informed and invest wisely.